You saved up your down payment, you got approved, and then you look at your first mortgage statement. And there's a charge on there you didn't expect. Private mortgage insurance, PMI. Nobody explained what it was. Nobody told you how much it would cost. And nobody told you how long you're going to be paying it. Today we're going to fix all of that. What PMI is, why you pay it, what it actually costs, which loans let you avoid it entirely, and exactly how to get rid of it once you have it. Let's go. PMI stands for Private Mortgage Insurance. And here's the first thing you need to understand about it. PMI does not protect you, it protects the lender. When you put less than 20% down on a conventional loan, the lender considers you a higher risk borrower. If you stop making payments and they have to foreclose, they might not recover the full loan amount from the sale. PMI is their insurance policy against that loss. You pay the premium, they collect the benefit. That's not a complaint, it's just how the math works. The reason lenders allow smaller down payments at all is precisely because PMI reduces their risk enough to make it viable. Without PMI, most lenders would require 20% from everyone. So in a sense, PMI is what makes lower loan down payments possible, but you should know what you're paying for. The cost of PMI typically runs between 0.5 and 1.5% of your original loan amount. Let's put some real numbers on that. Say you're buying a $300,000 home and putting 5% down. Your loan amount is $285,000. At 1% PMI, that's $2,850 per year, or about $238 per month. That's added to your mortgage payment every single month. Your exact PMI rate depends on a few factors: your credit score, your loan-to-value ratio, and your lender. Better credit score generally means lower PMI. Larger down payment means lower PMI. The closer you are to 20% down, the lower the rate. One more thing worth knowing. PMI is added to your monthly payment automatically. You don't get a separate bill. It's just part of what you owe each month. Check your closing disclosure. It will show PMI as a line item. Here's the good news. Not all loans require PMI. FHA loans have something similar. It's called MIP, or Mortgage Insurance Premium. We'll cover that difference in a minute. But conventional loans, there are ways around PMI. First, the obvious one. Put 20% down. If your down payment is 20% or more of the purchase price, PMI is not required on a conventional loan. Period. Second is VA loans. If you're an eligible veteran or active duty service member, VA loans require no down payment and no PMI. It's one of the most significant financial benefits of military service. Third is USDA loans. For eligible rural properties and income levels, USDA loans offer zero down payment and no PMI. There's a guarantee fee, but it's typically lower than standard PMI. Fourth is lender-paid PMI, or LPM. Some lenders will absorb the PMI costs in exchange for a slightly higher interest rate. You don't pay a separate PMI charge, but your interest rate is higher. Whether this makes sense depends on how long you plan to stay in the home, so run the math with your lender before choosing this option. The right path depends on your situation. Credit, savings, how long you're planning to stay in the home all factor in, but knowing these options exist changes the conversation. If you're paying PMI, there are two ways to end it. The first is automatic. Under the Homeowners Protection Act, your lender is required to automatically cancel PMI once your loan reaches 78% of the original purchase price, meaning you've built 22% equity. Based on your original amortization schedule, you don't have to do anything. It happens automatically. The second is by request, and this is the one most people don't know about. Once your loan balance reaches 80% of the original value, meaning you have 20% equity, you have the legal right to request PMI cancellation. You have to ask though. Your lender will not volunteer this. To make the request, contact your loan servicer in writing. They may have a formal appraisal to confirm the property value. If your home has increased in value, that works in your favor because the 80% calculation is based on the current value, not the original purchase price. If your home is worth more now, you may have reached 20% equity faster than your amortization schedule shows. Request an appraisal because it could eliminate your PMI years ahead of schedule. Let's clear up the terminology. PMI, private mortgage insurance, is for conventional loans. MIP, mortgage insurance premium, is for FHA loans. They serve the same purpose, but they work very differently. With conventional PMI, you can cancel it once you reach 20% equity. With FHA's MIP, it's more complicated. If you put less than 10% down on an FHA loan, you pay MIP for the life of the loan. There is no automatic cancellation. The only way to get rid of it is to refinance into a conventional loan. Once you've built up enough equity, typically 20%, talk about refinancing. If you put 10% or more down on an FHA loan, MIP cancels after 11 years. This distinction matters when you're choosing between FHA and conventional. A lower credit score might push you toward FHA to qualify, but if you're close to conventional territory, the long-term MIP cost is worth running through the numbers. PMI is one of those things that feels like a penalty, but it doesn't have to be permanent. You know what it is, you know what it costs, you know which loans let you avoid it, and you know exactly how to get rid of it once you have it. Plus, you have the added benefit of building equity on the home that you own versus continuing to pay rent to a landlord. Drop a comment. Did PMI surprise you when you found out about it? I read every one. Episode 5 is coming. We're going to talk about fixed versus adjustable rate mortgages. We'll help determine which one is right for you and when the math actually changes. We'll see you there.